Hi, I am Hao, a Singaporean investor, and today I'll be talking to you about a local supermarket chain, ShengSiong, with a supermarket business with a gross profit of 30%. ShengSiong stock has been up this year by about 60% and is currently trading at a $2.63 price. They have went up significantly due to their recent announcement of growth. They have hold a PE valuation of 27 and has a market cap of $3.9 billion and have a dividend yield of 2.43%. So what makes ShengSiong growth? What is ShengSiong? ShengSiong is a supermarket chain located in Singapore, which mostly are located in heartlands near housing estates. They also run an online platform and also have several locations located in China. What has the past 5 years of earning till 2024 have been like? As you can see, is since 2020, there's a significant growth for the net profit and revenue, and it dropped a bit in 2021 and 2022. However, they since have went back up, shown on the graph. So how's their recent earning like on 30 September 2025? As you can see, revenue has went up since the year previous by 14%, gross profit up by 15.2%, and the profit margin has decreased slight increase to 31.5%, and which is humongous for a supermarket chain, as I will show later on. And also the net profit margin is a healthy 10.5%, and they have earnings per share of 2.9 cents. You can see the growth all has been up since the year previously, and this for the 9 months. So what is some modes ShengSiong have? As you can see, running a supermarket chain in Singapore is quite tough. As seen previously, Dairy Farm International had sold their cold storage and giant outlets to a Malaysian group for 125 million after they found it not that profitable. However, ShengSiong has still managed to pull off a 10% profit margin as seen from the previous slide, net profit margin, and have outbid cold storage and giant. Also, ShengSiong has a strong moat due to the number of locations it has. Singapore is in the end a tiny island, and there's only so many stores out there to be able to board and grow. ShengSiong is number 3 ranking with about 86 stores as of 2025, and also lagging behind FairPrice, Giant, and Cold Storage. So, what are some things ShengSiong do really well? They have their own house brands, which they have been increasing. Now they have about 1,750 house brand products under 25 house brand labels. I am sure many of you have seen this type of brands. And also, they also very good brand awareness among the older folks, which also shop mostly at ShengSiong, with their ShengSiong TV show on every Saturday on our national television, I think Channel 8. And they also do seasonal lucky draws, as you can see here. So what are some things I feel that's done really well by ShengSiong is they also look after their staff really well. And this is something we should look for in a company where they take care of their staff. As you can see, during the COVID-19 pandemic, ShengSiong recorded strong earnings, and instead of keeping their earnings and rewarding shareholder, which they did, they also rewarded their staff. And I'm not too sure about you, but when I shop ShengSiong, I certainly feel that the employees treat me really well. What are some weaknesses? As such, for a company to have strong strength, they also have some weaknesses. As you can see, they also may eventually lose some earnings and some market share to online retailers such as Amazon or Redmart, which, and I understand they also have their online stores, but however, till now, the online sales only make up 1% of their total sales. And on top of this, they also may lose some of their sales to new concept stores such as Don Don Donki. And in the end, like I said before, Singapore is only so big. And if ShengSiong may not expand out of Singapore, the store growth may eventually stall. So, on top of this, what is one big weakness that ShengSiong have? Like every supermarket chain, they have a lot of workers, and they also have drivers for their delivery trucks and warehouses. the manpower costs. As you can see here, since 2024, the total rise of labor has risen by 4%. You can see this is from the Ministry of Trade and Industry. Even this also eat a majority of ShengSiong earnings, and they have to raise margin somehow. Labor cost is still a huge thing, and this will eat their revenues. Like I said, we don't need to worry too much for now. As ShengSiong, out of all the supermarket chains as compared to globally, ShengSiong managed to perform much better. This is from a chart I made from the second half result, first half of the year results. You see, ShengSiong have a gross profit margin of 30%, net margin 9%, as compared to even one of the world largest supermarket chain, Walmart, with a gross margin of 24% and net profit margin 2.4%. ShengSiong still have a 9.8 compared net margin, which means they're doing something correctly. How about store count growth? As I feel, for me, after reading through their financial reports, ShengSiong majority of its growth comes from its store growth. As you can see, this is from the first half of the report. I have copy and paste. Revenue rose 7.1%. 5 new stores opened to $764 million, driven by new store growth. From this, we can sort of guess that 5 stores equate to about 7.1% of growth. But we also need to note that with gross profit margin improving as well. And this is also from the report I found. The group plans to add about 3 new stores per year over the next 10 to 15 years. As you can see, since 2011, ShengSiong managed to grow its store count from 25 to about 85. And from the looks of it, with the amount of store FairPrice have, they could maybe one day surpass FairPrice if they continue growing. This is a chart I have made. So you can see the equations are since for the period of 1 year, they had a store count growth of 14%. We equate about 1.3% of growth per store. But you also must note that because it's 4.4% growth due to the existing store performance. And also this is about 1% per store. So from our previous slide, we can sort of tell that ShengSiong, more or less, if they continue with this plan, right, which they have written down here, they are about to grow about 3% if their margins still remain the same for gross profit margin and net profit margin, of course. So they have about 3% growth for the next 10 to 15 years, which is, in my opinion, not much. So what's one thing people also buy ShengSiong shares for? A lot of older folks in the past bought ShengSiong shares due to its dividend. As you can see, since 2015, for the past 10 years, its dividend has increased in a good way, which is upwards. You see 12%. But COVID year, remember when everyone stayed at home, people panic buy. ShengSiong dividend did go up because people bought more stuff. And of course, they offered ShengSiong repaid their shareholders by giving 5.3 cents, 6 cents. Let's equate to top 2.43% of dividend. As you must note, ShengSiong still have a very high valuation of a PE of 27 as of today, which is very high for a growth company. If every margin stay the same and they only count on store count growth, it's only 3%. If you're okay with that, ShengSiong is a good business. So overall, what's my thoughts on ShengSiong as a company? Firstly, I feel it's very hard to replicate as they own many grocery chains and they own their own supply trucks and they own their warehouses, which they own from top down. So they own all the way from the warehouses all the way to the shops to the cashiers, which is a very good way, which is hard to replicate. They also have very high profit margin as compared to many other grocery stores even in the world. And also, I feel this is a very good thing for a business to have, as if your staff is cared for, I feel they will also take care of the business for you. And lastly, as proven from COVID, while a lot of businesses were suffering, ShengSiong recorded record profit and pay out more dividends to their shareholder. And it's recession resistance because a majority of people in Singapore knows that ShengSiong is a good business where most of their things are cheaper as compared to the outside. And also, however, there's some negativity. Growth may slow, but reported in their report, they had said they plan to add about 3 new locations, and from our own calculation, it calculated that about one store is 1%, and 3 store, like they reported they plan to do, 3 store per year would equate to about 3% growth for the next 10 years. 3% per year, the next year, 10 years. And with such high PE valuation of 27, I don't think that is a good way for growth. But in the expansion, Singapore is only so big, with FairPrice and NTUC dominating so many of the stores, maybe a bit harder to expand. But we may not need to worry with so many new housing projects going on in Singapore. They may be able to expand to those new housing estates. And also, manpower plays a huge part of ShengSiong costs. And lastly, due to inflation. Lastly, will I buy ShengSiong share at this current pricing of $2.60? Personally, I would not. Due to its high PE price and its expected growth rate, as stated, they plan to increase 3 store per year. No. But if the share price do drop, I would buy, as it's an excellent business which take care of its workers and repay its earnings to the shareholder. And recession resistance, which is a business which can help protect your portfolio in economic downturns.